oh, I'm going to jump right here into assets and then M2. So I'll split up these videos. But anyway, so here we are with NASDAQ, and we're just going to look at the year-to-date numbers here. Year-to-date up 6.7%. Man, that was a rough ride in March, April, right? But it's come back, and now we're up. We've got an overall increase, 6.68. S&P 6.76. Whoa! This is the first time in a long time we've seen the S&P do better than the NASDAQ, right? It has the same basic shape. It just didn't take the biggest hit the way that all of those tech stocks did back in March and April from DeepSeek and NVIDIA primarily. But yeah, so down, back up, all-time high, beating the NASDAQ. And then this is crazy. So, I always show the Dow Jones moderate portfolio, 7.95. Oh my gosh, it's beating both the S&P and NASDAQ. How and why is that? Well, because it didn't take the drawdown as much, right? So I guess that's a really good lesson, just a reminder of why we invest the way that we do. It's not that bonds did well, right? As you'll see in a second. It's that they didn't lose much, right? And so if you go on the website, I think it's under investing on the videos. You scroll all the way down. There's a graph that I have from the 2008 crash that I built, and basically the people who were most aggressive are in the S&P outright. It took them like 6 years just to come back to break even, whereas people that were like moderate or conservative, it took them either 2 or 4 years to come back to even. And so I think it was a 10-year timeline that basically it was the moderate, the conservative, and the aggressive that were all at the same point, and then the S&P came and beat them. So it was like, yeah, there's value in not taking a loss because you're compounding a higher amount versus compounding a lower amount, and it's just irrecoverable, right? They say don't sell in a down market and you don't realize the loss. Oh yeah, you do. You definitely do, because you're not getting compounded returns on the upside because you took the loss, right? And so that's why we're seeing that the Dow Jones moderate did so well relative to the two. It took a drop, just not as much. All right. So let's look at the asset classes. Large cap value for the month of June. That's what I'm doing. And year to date. Month of June, 3.5, 3.5, 7.25, 7, 5, and 13.5, or whatever we'll say. 3, 2, 4, 3, or 4, 3.5, almost 6. Like, wow. Here at the top, actually, it's all growth. Growth has had the best in the month of June. But if we look at year to date on the 7, 5, the 4, 2, like it's not really there. It is on the mid growth, but I'd say year to date on the large, and then mid growth is pretty much it. Everything else, not so much, right? These not so much. It's just these four. So that's been interesting, actually. If you're in big companies, they're doing well. If you're in small companies, they're struggling. There's an argument to say that regulation as well as inflation is having a dragging effect on the smaller companies. If they're trying to grow, if they're trying to scale, and they need to borrow money, or you can't really issue stock because there's nobody interested. Everybody's just going up here. And the primary driver of large cap stock is going to be 401k plans, all of the algorithms and the big pie charts of the brokerage companies out there where one size fits all, and therefore everybody's in them. And so as everybody continues to buy into the same stuff, it's just a reinforcing loop there. But yeah, the only thing that's down is small cap core for the year, even after that really rough March. Hopefully you didn't sell. International has been on an absolute tear, right? 20%, 15.5%. Emerging actually had a better June than international, but what's doing a lot of this is interest rates. The fact that ours are high and not cutting relative to others. Tariffs, right? Oh my gosh, tariffs. It's going to be this terrible thing, and nobody can make any money, and we're all just going to have no goods or services anymore across borders. Yeah, right. All right, so let's look at bonds. Bonds are always interesting. That was a pun. So 0.64, 1, 2. Hey, that's all normal. That's what we would expect. that would be called positive correlation. And that's the right leverage, I would say. We've got the 3, the 4. Longs are a little on the short end on year to date, and a lot of that comes from the expectation of rate cuts. We had this actually factors in last week, but before last week there was this big expectation that we would be cutting rates, and we saw long terms take off. And actually, there were a couple of segments on Bloomberg and CNBC that were pushing for, yeah, it's time to buy longer duration in your bond portfolios. And it's like, yeah, we already did that. Haven't been paid for it yet. Still been waiting, right? But once we do see rate cuts, that will make a lot more sense. Tips have had a pretty decent year, 1% on the month. That's good. Then we've got the high yields. High yields have not done very much. In fact, like, where is the premium for the risk? I don't see a risk premium in there. If I can get just a tip paying more year to date, not as much on the 1 month, but man, for the potential to lose my principal and not get paid back, that's not enough, in my opinion, for high yield. But we haven't really been in much high yield anyway. Oil had a great month, but it's down year to date. Wonder why? How can energy prices go down? Anyway, gold, oh my goodness, 24.4% year to date. It's a flat month for gold because of the waves on interest rate cut expectations. Real estate is flat. Guess what they're waiting for? Bitcoin is recovered. It's over, I think, over 107 now. But yeah, it took a bit of a hit in the whole March, April timeframe. So to come back to 16 is really strong there. Alrighty, so now let's talk about the Federal Reserve and specifically M2 money supply. Very quickly, everybody's seen this graph. This is how much dollars have been in existence from 59 until current, right? And so when you had the bailouts from 2008, there's that. Oh my gosh, let's panic. And then we've got COVID. Oh, let's print into infinity. And then we did quantitative tightening. Silicon Valley was going to blow up. And now, since, I mean, we're going to have more inflation. That's what that's showing. If I show the up close here, Silicon Valley Bank and Signature Bank crashing, and it's now higher. So all the quantitative tightening is gone. Everything we were tracking all of last year and me saying, yeah, good job. They're doing a good job selling bonds. Well, it's been undone. Now, it's technically not the Fed's fault in this instance, unfortunately. Here are the numbers. So we're at 21.9 trillion. It's the highest ever. A month ago, it was 21.6 trillion. And January is 21.5. A year ago is 20. Well, let's just call that 21. And I always do January of 2020 because that's pre-COVID, 15.4 trillion, which is not good, by the way. That 15.4 trillion just is basically nobody can buy a house without the government insuring it, which doesn't make sense. Maybe there's money they should be putting down on it. But yeah, so a 48% increase in money supply since COVID. We added 1.2% in 1 month. Do the math on that. That's 14% inflation on a trend line. Thankfully, we haven't done that trend line all year. Year to date, 4.5. So even if we continued that, it would be 9. Unfortunately, I believe we're accelerating that. And so it's usually a 16 to 24 month lag from when we print the money to when your prices go up. Okay, so inflation is likely coming. That's the bottom line here. At a rate of 9% a year? Yeah, I think so. Yes, I especially think so with that big, beautiful bill. I think that pretty much cemented that this is going to continue. This trend line is going to accelerate. So let's see how high that can go, because national debt's already 37 trillion. So let's see if we can just match the dollars with the amount of debt that we have. It's not the answer, by the way, but that's what they're doing. All right, let's talk about the balance sheet, because I had just said I was tracking the Fed and they were doing a great job, Silicon Valley, but they are still doing a good job, right? So this is the amount of money under $1 trillion is how I should say bonds primarily. This is the amount of bonds that the Federal Reserve sits on, earns interest on. They print money out of thin air to buy these bonds from the government. This is how we can do deficit spending. You want to know a quick fix is make that illegal, and all of this stops immediately. But because of the system that we're in, you can see in 2008, they had to start buying up AIG and Bear Stearns and all of the stuff that was blowing up in the mortgage world back then. And a lot of mortgage stuff, they continued to have to buy mortgages into 2012. Then they had to keep buying mortgages all the way into 2018 until they tried to stop. That was quantitative tightening, where they started selling mortgages and government bonds until COVID, in which case they started buying bonds and stocks and mortgages because everything was being defaulted on. And so they would hold it, print the money out of thin air, and if it gets defaulted on, so what? We all pay for it in inflation. That's how it is. So all of that with PPP and unemployment and all that fun stuff, Silicon Valley, and then they've been quantitative tightening, meaning selling off their bonds and mortgages and equities. And that trend line's kind of continued. You can see it's tapering a bit here, how it's like flattening. I wish it would just go straight down. But why's the Fed got all of these assets, real assets, by the way, that taxpayers owe them, and they got it by just turning on a counterfeit machine? If I do it, I go to jail. If they do it, they get profit. So let's zoom in. Yep, it's flattening. That's the key there. All right, so they currently have 6.66 trillion in assets on their books. A month ago it was 6.7. Year to date was 6.85. So you can see this trend line, right? It's black because that's good. We want them to sell this off, but there's still 60% more than before COVID. So they haven't undone much. They've undone, I think we were up to double. I think it was like right at 100%. So like they've undone 40%, which I guess is good. I want them to continue doing this by selling these assets back out into the market. So let's look at the difference here. I just dollars instead of percentages. The balance sheet shrunk by about $50 billion in the month of June. And M2 grew by $260 billion in the month of June. So the government spent $310 billion more than they took in the month of June. So this is how we do things now, I guess. It's how we've always done things over the last few decades, at least. But it is unsustainable, and it's sad to see that we're back at it. So your portfolios should match back to the old norm, with the new norm of spending being a higher percentage of GDP, because make America whatever. I don't know. I mean, the financial side of this is rough, but we know the inflation's coming. My job is to put you ahead of it so that those excess costs and profit and tax and all that stuff that comes out of that company yields more to you as an investor than it hurts you as a consumer. That's my job. And to keep track of all the fun tax stuff along the way that allows us to get way ahead of the curve by following the rules that are written for really smart people, or for people to hire smart people to manage for them. So that's the bottom line. It's not great news, but that's the update, I guess. We've gone through the firm update, the assets, all the client meetings, the growth stuff that we've got going on here, the beneficiary review that's coming up, the reallocation based on all this crap. It's going to look actually a lot more like the one we did in 2022, November of 2022, the way that we were skewing a lot of those asset classes, preparing for the inflation to hit. That's kind of what we're doing this time. So if you're curious, that's what that will be. If you have questions, if you have concerns, if you want to talk about this stuff before all the trades get placed later this month, feel free to reach out, send us an email, call, set up a meeting on Calendly, whatever works best for your schedule. And we'll be happy to talk about it. But other than that, there's some disclosures to read to make sure that I don't get sued for my opinions. Professional and personal, I suppose, are in here. But yeah, thanks for being clients. Thanks for helping us grow, helping my family have a life where the kids are going to be educated properly and not necessarily college, by the way. It just means that we can pour into them and teach them the things that actually matter in life instead of dumbing them down and being told what to think. And also, thank you for the patience for us to get to this point with the office, with hiring, with there've been some inefficiencies and some issues and paperwork and so forth that we've finally gotten worked out. But thank you for your patience, and thank you for the relationships as well. This is my life. This is my livelihood, and I wouldn't trade it for the world. So we'll look forward to seeing you soon. Be on the lookout for those beneficiary review reports, and hope you like them. Give us some feedback, and we'll see you next time.
Flamingo.